Doug, how are you thinking about this? Obviously, there's always going to be give and take in the reactions, but talk a little bit about Amazon in particular and its spot within this whole AI boom.
Yeah, Mike, we actually have not owned Amazon at Intelligent Alpha. Our models, we use AI to do our stock picks. Our models haven't liked Amazon, and it's been right. It's been the worst performer of the Mag 7 year to date. And I think the primary concern is that question around AWS. We just saw an incredible cloud number from Google, Microsoft, even though they didn't quite hit, I think, what investors were hoping with 37% growth in their guidance for Azure. They had a great number. And so the pressure is on. The problem for Amazon has just been they haven't had a top tier sort of offering, just like Azure and OpenAI, Google, GCP, and their AI Gemini. They need something. They need to do a deal with OpenAI, or they need to really ramp Anthropic and get developers excited about that to drive that AWS revenue growth.
All right, so we'll see if they have answers for any of that. Let's turn now to Apple, which I think is one that you do own and which investors feel pretty comfortable, at least in the last couple of months, with its position. So what are you going to be looking for in this report?
It is all about the iPhone 17. I think that coming into this quarter, the last month, it feels like we've had universal positive reports about consumer demand for the iPhone 17. It's been better than investors had been expecting once the phone was announced. And really what I'm thinking about is, what does that iPhone 17 growth sort of translate into over the next year? If you look at the street numbers, the street's expecting about 5.5% iPhone growth into next year. I think that number could be higher single digits. And so we'll get a sense from guidance tonight how Apple is thinking about really what that growth will look like for next year.
And then, got to have you weigh in on the Meta reaction here and whether it's symptomatic of anything, whether it's a loss of patience in their strategy on CapEx or in general, investors getting a little bit less patient with the open-ended spend.
It's funny, they've been the one where they've probably had the most actual direct benefit from their core business to using AI. I think AI has been driving a lot of the revenue growth we've seen at Meta. But the problem for them is they've been far behind in terms of actually developing their own unique technology. They've put a lot of development and resources into Llama, which just hasn't really taken off as a model. It is far behind the leaders in terms of GPT and Gemini. And now they're spending a lot of money. They've hired a lot of talent. They spent billions of dollars, which was talked about on the call, to bring in new talent to try to rejuvenate their superintelligence lab. And they're talking about spending even more in terms of cloud resources. They wish they had more capacity. They said it. They're going to get it next year. And I think they're going to have to show more in terms of actual AI product that customers are going to pay for beyond just improving their ad business.
The company also issuing like $25 billion in new debt today to help finance this. Of course, it's very manageable on Meta's balance sheet. But in general, is the increasing use of debt financing for data centers and such going to become a concern for you?
I think it's something we should note, we should flag, and we should pay attention to. But I go back to just what has been the commentary from the hyperscalers. Meta, Microsoft, and Alphabet universally all said they wish they had more supply. They've got more demand than they know what to do with. So they need to keep building so that they can monetize that. And ultimately, if that demand stays solid, they'll have no problem paying off the debt.